Well, welcome to Investor in the Family Radio, a podcast about learning to invest. My name is Brian Bain, and I'm your host. And it is good to be back with you here today. And last few weeks have been, or maybe a month or so, it's been a little while since we've had a more traditional weekly podcast here. And I thank you for your patience with that. But I hope that all of you were able to benefit from that shift or upheaval, you could say, in schedule with all the focus on the DIY Investing Summit of late. And that obviously absorbed a lot of my attention for some time, all the interviews for that summit, and then the build up to, promotion of, and everything else that went into that. But again, we promoted that here with you guys as well. And I know a lot of you were able to participate in the summit. And so I thank you for that. And I hope it was beneficial for you. And it was a great partnership with Seeking Alpha and about 25 great contributors from Seeking Alpha, most of whom are former guests here on the podcast, but not all, of course. In any event, the summit was a great success and something very enjoyable for me. One of my main focuses with the summit was to sit down with, again, about 25 of those contributors and with 45 minutes to an hour with each one of them and ask them a lot of the questions that were on my mind as I want to grow as a DIY investor. What are the things that I wanted to know from them? Even down to random things like what books had the most impact on their investing. What would they go back and teach? If they could say one thing to themselves or go back to themselves when they started out as investors and give them advice, what would they tell themselves? Top advice for DIY investors, outlooks for 2017, and all that kind of stuff. And it was just really, really fun to see just the wide scope of responses from a lot of really high quality investors. And it was fun to see how in many cases there was a lot of overlap, there was overlap. I shouldn't say a lot of overlap, but in other areas, there's a lot of variety as well. And so it's fun to see what are the core things that people kept reinforcing over and over. And well, that's probably something I should reinforce as well. But also what are the things that are nuanced? And some people do it. Some people go left, some people go right, some people go straight, and are able to see success in each one of those directions depending on their overall plan, objectives, and then the discipline of being able to stick to that plan. Nonetheless, very, very encouraging and affirming for me, and I think I will be building content out of what I learned from that summit for a long, long time. And the summit, it was free initially, and then if you wanted extended access, it was $97, and then I upped the price to $497 and I honestly still feel like that's a great deal in my opinion. Obviously, I'm biased. I have for people here on the podcast, if you missed it and you still want to get in there and get the content for $97. I have like a back door left open for you. If you go to DIYInvestingSummit2017.com, that's DIYInvestingSummit2017.com. You can still go in there. It's not free anymore, but you can get it for $97, and which in my opinion is a steal. But again, go check that out if you're still interested. I'll keep that open for a little while longer in any event. But today I want to get back into some more up-to-date news, and I'll also give you a heads up. I plan on taking some time off now because the summit took a lot out of me. So I probably will not release one of these podcasts next week, but should be back on track the week after that is my intention. So heads up there. But this week, again, basing a lot of my content off of Randall Forsyth's column, Up and Down Wall Street column from this week's Barron magazine. His title was Goldilocks to the Rescue. I probably would never title something that, so I'll come up with something different and better, in my opinion. You'll see that on the blog if you want to check that out at investorinthefamily.com. So again, what's going on this past week, this current week in the investing and economic world? Shocker. He started off by talking about President Donald Trump, and things going on there. I have no desire to get into a lot of the political conversations regarding immigration or otherwise, and that doesn't mean I don't have an opinion, but this is not the forum for that, in my opinion. I will say I would love to see our president show a little more tact in his communication. That is not a political, meant to be a pro or con comment in terms of going for or against anyone, but man, I just sometimes think you could save yourself so much heartache, just a little bit of heartache, with a little bit of tactfulness in your communication, but we'll leave that alone for now. But the main focus of the conversation is not on Donald Trump, which is great, although that is the beginning of the article. A lot of it comes back to just trying. We do get into conversations about Russia and the UN, the U.S. ambassador to the United Nations, Nikki Haley, who took a pretty stern tone toward Russia over this last week or so. But one thing that they noted is the fact that while the U.S. U.S. stock market has done well since Trump was elected, apparently the Moscow market has done nearly 3 times as well, which is pretty amazing. So what that means. I guess all that means is people investing in the Russian stock market think that a Trump presidency could be beneficial for them. That doesn't really say anything about Trump necessarily, even though that seems to be something people like to make a media field day about. We'll see. Nonetheless, coming back down to the question that everybody always wants to know about, and that's the Federal Reserve. We're looking at some of the economic indicators that have been released of late. And it seems that basically there's nothing really great, but also nothing really terrible either. And so a lot of lukewarm numbers coming out regarding the economy. And so, as they say, it should be enough to keep the Federal Reserve at bay. Let's see, January employment report was really more reflective of Obama's presidency than Trump's presidency. And even though the lag time for impact of anything a president does is so long, it's kind of ridiculous to think that anything in the next few weeks will be super reflective of Trump. But who knows? We'll see. People don't always think logically, unfortunately. So on the non-farm business payroll, there were a lot of jobs added, but then there's some revisions made, which honestly I don't care because they make things way too complicated. So bottom line is it was a fairly lukewarm number. Jobless rate, fairly similar. The labor force grew. So basically the labor force participation rate did edge up a little bit, which is encouraging, but it's still at nearly generational lows. But it is above the lows of December, which is great. That's not a number I go back to regularly, the labor force participation rate. So basically how many people are actually participating that are eligible to participate in the labor force that are, because in my opinion, the unemployment rate is incredibly misleading. A worthwhile number, but taken by itself, it just leaves a lot to be desired in my opinion. But this labor force participation rate did bounce up a little bit, like 0.2%, but it's still at such low numbers. It's just testifying to the fact that a lot of people are out there without jobs. Let's see. Another thing that was this troubling issue is that there was, as far as people in the prime age, working age, which is considered to be 25 to 54. Sorry to any of my 55-year-old friends out there. But in that prime age, 25 to 54-year-olds in that labor market, there was a 305,000 drop in workers, which is terrible. And partially that was offset by a 195,000 person increase in the 55 plus contingent on the job. So, very glad for those 55 plus year olds, but the prime spending age of life is not necessarily there. And you got people 25 to 54 who are still struggling in the workforce, which is a problem. Pay increases were basically nothing, which is terrible. 0.1% rise in average hourly earnings. But the fact that 19 states increased their minimum wages last month does not make that number sound very good at all. And then after seasonal adjustment, here we get into a lot of different specific detailed numbers, which I don't know how helpful that is over the audio. In my opinion, it's not super helpful. Get into construction payroll expanded, retail employment increased a little bit. The underemployment rate rose to a 3-month high of 9.4%, up from 9.2% in December. And apparently a metric that is near and dear to Janet Yellen's heart. Obviously, for those of you who have forgotten, Janet Yellen is the Federal Reserve chairperson. And the number is folks working part-time for economic reasons. And so basically, that was a huge surge in that number, which was of 242,000 people who are working part-time for economic reasons. And I think that's basically the idea of people who would rather be full-time but maybe can't, so they're working part-time instead. So basically the idea, you have a lot of people who want more employment but are underemployed. That's how I understand that number. And again, that's the number that Janet Yellen apparently takes very seriously. And we get into some things about the Institute of Supply Management's manufacturing gauge rose to 56 from 54.5, while the ISM service sector measure slipped marginally from 56.5 or from 56.6 to 56.5. And bottom line is a reading above 50 indicates economic expansion. So all those are positive, but again, still pretty lukewarm. So basically all these numbers together should be enough to keep the central bank from raising its federal funds target rate at the March meeting. So all that being said, we probably shouldn't expect anything significant in the March meeting as far as rates rising. And apparently the Fed funds futures market is currently pricing in a quarter point hike from 0.5% to 0.75% in June. So mark your calendars, everybody. The new date to look forward to is June, when people are officially expecting another 0.25 quarter% increase in federal funds rate. Let me get my terms right there. Yes, the Fed funds target rate. So interesting stuff to note there. And as far as one other thing here that I thought was interesting and noteworthy is the fact that corporations are still taking significant advantage of the really basically cheap money. And by bringing bonds to the market by the boatload, quote unquote boatload, so they can then buy back their own shares. So basically you have the situation where because of extremely low interest rates, money's very easy to access, which is not a new thing, but you have companies that are selling, bringing more and more bonds to the market so they can get money and then use that money to buy their own shares back, which is kind of a crazy dynamic to be happening on a massive scale. Specific companies that are highlighted here, you've got Microsoft, Apple, AT&T, Time Warner, Broadcom, and then Brocade Communication Systems. Oh, wait, I got that wrong. Sorry. The ones that are, the ones, Microsoft, Apple, and AT&T. That's the ones to focus on there. And and even though Apple has $246 billion in cash, most of it overseas, they're still borrowing money to buy back shares. And so here's where it really significant, in my opinion. For the first time, global net equity issuance turned negative, which created support for stock prices. So basically, more shares are being purchased back by companies than issued by companies. So usually issuing new shares, it would be a way to raise new money, but that has officially turned negative in terms of equity issuance. I can only assume that includes IPOs as well. It doesn't say specifically, but I guess for that number to have integrity, it would need to. So that's pretty significant in my opinion. You've got companies really significantly taking advantage of low rates to sell bonds, to get money, to buy back their own shares. And so you have this dynamic where apparently there's this idea that quote unquote pundits like to call profits are the mother's milk for stock prices. So basically increasing profits is what boosts stock prices. But of late, equity babies are being fattened on artificial formula from the capital markets. So again, the idea that instead of stock prices being fueled by growing profits, they're being fueled by company buybacks that are being fueled by issuing new bonds because of low interest rates. So all the more exciting news out of Wall Street and the financial world, they will always find a way to make things work for themselves, right? So anyway, but again, that's some of the updated news for this week. And so hopefully that'll help inform you, if nothing else, help you feel a little more confident in being up to date on some of the worthwhile news out there. And as usual, pretty much none of the news is worth taking action on. And so, but I think it's good to not be ignorant. So when big things do happen, or you see things in the news or conversations, you can say, hey, I already knew that, or that's good to know. I'll take that under advisement as I stick to my very disciplined and focused investing plan and do not allow myself to get off track by any kind of sensationalism going on in any level of media, including this podcast. And so again, I will be taking off this weekend next. So I haven't decided yet if I'll launch out an old podcast into the feed for next week for you guys. I kind of want to, but I figure some of you may still be catching up. I put out probably about 15 different clips from the DIY Investing Summit. All of them are fully self-inclusive. Like you don't have to have the rest of the interview to be able to enjoy them. So if you missed some of those, I would encourage you to go back and listen to several of those. Again, those interviews from me were probably one of the most significant collection of investing wisdom that I've experienced in all the interviews I've done on this podcast. And I don't care if you buy it or not. I'm not putting an ad out there. I'm just saying it was a very significant experience for me in terms of really galvanizing a lot of my thinking around investing and how I want to personally approach investing and what I want to do with Investor in the Family as a business and this podcast as part of that business and everything else. So if you are interested, that's at DIYInvestingsummit2017.com. DIY Investing Summit 2017.com. But that is the end of the show for today. If you ever need me, be sure to reach out. Brian, Brian, at investorinthefamily.com. I really love to hear from you. And it's exciting as the show grows to get to know more of you out there in the audience and learn from you. And because sometimes you say things that make a difference for me and help me grow as an investor, and it ends up being reflected in this podcast, whether you see it directly or not. Anyway, that's a wrap for today. Thank you so much, and have a great rest of the week. The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.